In this presentation, we will be looking at the types of evaluation reports that we'll be looking at in this course. The typical report types used for mine investment evaluation can be divided into four major categories: feasibility evaluation technical reports, public disclosure reports, due diligence reports, and valuation reports. If we look at the category of feasibility evaluation technical reports, we see that they can be subdivided into early technical reports. And if positive, that leads into mineral resource reports. If that is positive, then we go to feasibility reports. And after a final investment decision is made, it moves to detailed engineering design reports. Early technical reports are also sometimes known as exploration reports. These include reports on geology, mapping, historic production, geochemical or geophysical surveys, sampling reports, drilling reports, including significant intervals, such as they found in the drill hole 30 meters of 0.5% copper, and also assay results. Once the initial data is collected, then you move on to a mineral resource report. This is where you estimate the tons or tonnes or volume and grade or the quality of the mineralization being examined. Typically, mineral resource reports will have the geology, the sampling, and then added sections being the database and the data verification of that database, the geological or lithological modeling, discussions on the 3D or block model that is being used, and the estimation techniques that are used. And finally, what the mineral resource actually is at the project. Mineral resources are important because these are the foundation of all mineral projects. Without officially defined mineral resources, you do not have a project. Likewise, a poor resource estimate dramatically increases the project risk. Once we have a defined mineral resource, we move into feasibility reports, which is the development of a business plan for the deposit. Common categories are shown on the right side of the screen, which include scoping studies, pre-feasibility studies, and feasibility studies. Our textbook, Mineral Properties Evaluation, defines these, as shown on the left side of the table, as preliminary feasibility studies or option studies, intermediate feasibility studies, and final feasibility studies. As you're preparing a feasibility study, there are a lot of other technical studies or engineering reports. These are usually attached as appendices to the pre-feasibility or the feasibility report. And there'll be additional resource and reserve estimation reports, reports on mineralogy, metallurgical testings, optimization studies, geotechnical studies, hydrological studies, site selection, marketing, environmental studies, social license issues, and just a lot of different reports that go into the feasibility report itself. Once a positive commitment by the company has been made to go ahead with the project after the feasibility study, you get another group of studies that we won't really talk about a whole lot in this class. One of them being feed studies or front-end engineering design, and the detailed design. And these are reports that the engineering procurement construction management or EPC or EPCM firms that are building your project will usually produce prior to construction and provide afterwards as built drawings. We will concentrate on the feasibility study reports in this class or the business plan for a mineral deposit. And as you can see in the red box, this is the context in which Dr. Bullock talks about pre-feasibility studies and feasibility studies. His category of preliminary feasibility studies is really option studies, looking at trade-offs on mine size versus processing plant size versus equipment size, just different ideas of how you could develop the deposit. Once those have been conducted and you settle on a preferred plan, then you move into an intermediate feasibility study. Commonly, this is really known as the pre-feasibility study. Once those are completed, you move towards a final feasibility study, or basically just the commonly termed feasibility study. Now, we need to look at what the definition of a pre-feasibility or preliminary feasibility study is. This is a definition taken from the International Reporting Template of CIRSCO, a internationally recognized consortium of countries to try to standardize definitions. They state that a pre-feasibility study is a comprehensive study of a range of options for the technical and economic viability of a mineral project that has advanced to a stage where the preferred mining method, in the case of underground mining, or pit configuration, in the case of open pit, is established and an effective method of mineral processing is determined. It includes a financial analysis based on reasonable assumptions on the modifying factors and the evaluation of any other relevant factors which are sufficient for a competent person acting reasonably to determine if all or part of the mineral resources may be converted to a mineral reserve at the time of reporting. A pre-feasibility study is at a lower confidence level than a feasibility study. And this is interesting because, as I've highlighted, it's a study of a range of options. Okay? And that there are reasonable assumptions about what we call modifying factors, which we will explain later on in another presentation, and the evaluation of relevant factors that are significant for a competent person to determine all or part of the mineral resource which may be converted to a mineral reserve. Now, if we go back and look at Richard Bullock's classifications in the text, notice that preliminary feasibility study or option study is part of the international definition of pre-feasibility study. Going on, the international definition of a feasibility study is a comprehensive technical and economic study of the selected development option for a mineral project that includes appropriately detailed assessments of applicable modifying factors, together with any other relevant operational factors and detailed financial analysis that are necessary to demonstrate at the time of reporting that extraction is reasonably justified or it's economically mineable. The results of the study may reasonably serve as the basis for a final decision by a proponent or a financial institution to proceed with or finance the development of the project. The confidence level of the study will be higher than that of a pre-feasibility study. And so once we look at the feasibility evaluation technical reports, the next category is public disclosure reports. A public disclosure report is issued on a minerals project, is a summary and I stress summary, technical report issued prior to, and prior to needs to be stressed, to the disclosure of the mineral content, the tons and the grade or quality of the deposit. We talk about disclosure. What is disclosure? Disclosure is anything that you do in public. If you're a company and you have this project and you're talking about it at PDAC or giving a presentation or anything else, that is considered disclosure, along with anything you talk about on the news release or any corporate filing that you're requires that there's be a technical report issued prior to that disclosure. If not, the securities people will climb all over you, and you'll probably have to issue a retraction of the presentation or a retraction of the news release or something like that prior, and then you'll have to file the technical report, and then you can talk about it in public. Okay. And this public disclosure report, it discloses anything and all the pertinent information to support that disclosure. And this is important because they're looking for transparency. And these items include, but not limited to, the location of the project, such as it's 500 miles west of Winnemucca, Nevada, or something like that. Ownership. Well, I own 100% of the rights. I only own 50% of the rights. It talks about geology. It talks about the sampling, how the mineral content, mineral resources, and or mineral reserves that are being disclosed were determined. It talks about permitting, environmental requirements, social aspects, if you've gotten that far yet, and any other material that you wish to talk about needs to be in a summary technical report, which is a public disclosure report prior to any of that disclosure. The common types of public disclosure reports that you'll typically see are NI 43-101 technical reports, JORC technical report, and SEC technical summaries. Now, if we look at the NI 43-101 technical report, it must follow the prescribed outline in NI 43-101F1. This is a document which has 27 items, and each of these items become a chapter in the technical report, the NI 43-101 technical report. Now, these reports must be filed on SEDAR, and I think that you guys have already had some practice in looking up and finding reports on SEDAR. And typically the types of reports that you are going to have to file include mineral resource technical reports, and sometimes scoping studies, technical summaries, but definitely you'll need to be filing a public disclosure technical summary on pre-feasibility study and feasibility studies. The pre-feasibility study only needs to be the selected options, not on all the options that you are looking at. And then there's a special NI 43-101 technical disclosure report, and that is called a preliminary economic analysis, or PEA. And this is a special case of a scoping study. It's usually not done to a pre-feasibility or a feasibility level. It is a lot a higher risk, I should say, than either a preliminary feasibility study or a feasibility study. And it is only an economic justification for more work. It does have a discounted cash flow. That's one of its characteristics. But it's the only report that can utilize inferred resources, and we'll discuss those in a different presentation, in the discounted cash flow. Otherwise, inferred resources in pre-feasibility and feasibility studies must be treated as waste and thrown out in the mine plan. And as I said, it's usually completed to a scoping study or less. And the problem with these is they're often misused and can be misleading, and you cannot use them to talk about mineral reserves on a project. Companies love these. Stock exchanges, while they allow them, do not like these at all. And that's why I call it a special case, because people tend to take these, getting back to it being misused or misleading, and say, oh, well, the Dr. Bob mine 500 miles west of Winnemucca has this sort of economic characteristics, and there's 100 million tons of potentially mineable mineral resources at 5% copper. And that's misleading, because once you do the pre-feas and the feasibility study and the engineering work, that 500 million tons is likely to turn into 100 million tons. Now, the Ontario Securities Commission has issued kind of a comparison between a preliminary economic assessment and a pre-feasibility study and a feasibility study. And this is the chart that is in their PDAC 2015 presentation. And what's important to pull out of this chart is the second line of concept. A preliminary economic analysis can thought about what a mineral project on the deposit could be. Whereas a pre-feasibility is what it should be, whereas a feasibility study is what it actually will be according to our business plan. Now, also important in this table is the fourth and fifth lines, which talk about the accuracy and the amount of engineering that goes into these different reports. Cost accuracy, can be plus or minus 50% for a PEA, or you can think about it as a scoping study. Okay. In other words, if you determine that it's going to cost $1 billion to construct the mine, the real cost could be anywhere from 500 million to 1.5 billion. If we look at a pre-feasibility study, you're narrowing that range down to plus or minus 25%, or 750 to 1.25 billion. Whereas with a feasibility study, your accuracy is even better. It's plus or minus 15%. The engineering, we can see that with a preliminary economic analysis, there's not a whole lot of engineering that has gone into the project yet. Whereas with a pre-feasibility study, we have at least 1 to 5% of the engineering done, and with a feasibility study, 5 to 25% of the engineering completed by the time we finish the feasibility study. Now, if we look at JORC instead of NI 43101, they have no prescribed format, but the important thing is they include in the JORC code Table 1, which addresses various information which must be discussed in the report. You don't have to discuss it in chapter 1 or chapter 15 or chapter 27 or whatever, but it must be discussed someplace, and you must include the table showing that you have discussed that. And if an item in their table 1 is not addressed, you must answer the question beside the item that says, we have not considered this and this is why. If not, then why not? JORC reports, which we're not going to be really looking at in a whole lot of detail in this class, are typically referred to as either a competent person's report or a CPR, or an independent technical report. SEC reports are a different animal. Previously, all filings on any U.S. stock exchange was governed by Industry Guide 7. And the shortcomings of that is you could not report mineral resources. You had to have at least a pre-feasibility or a feasibility study to be able to report reserves. This has been superseded by what we're calling SK 1300. And this is mandatory as of January 1st, 2021. And all the specifications are found in CFR Title 17, Section 29, or excuse me, Section 229.1300 to 1305. Hence the terminology SK 1300. Now, with SEC technical summary reports, we see that it's a prescriptive format. In other words, you've got to have all these sections. And part of it is whether or not you're doing something akin to a preliminary economic analysis, a PEA, or a feasibility study, or a pre-feasibility study. Some of those chapters go in and out depending on what stage and what type of report you're reporting on. They also require an initial assessment to support the disclosure of mineral resources. And this may or may not be combined with the technical report summary. It may be a standalone document. It just depends on what you're doing and what you're trying to do. But mineral resources you have to have, typically like a NI 43-101, not only a resource report talking about how it's written and how it's been estimated and the data, but you also have to have some sort of an initial assessment saying you think this thing is going to be eventually economic. Now, moving on to the different categories, we look at due diligence reports. Due diligence reports address the legal obligation or duty for a company to complete an ordinary care assessment prior to purchase, investment, or financing of a project. These reports are very common too in real estate transactions and other major transactions for most companies. The size and the content of the due diligence report depends very much on the purpose of the due diligence. For one, many times a financing organization will look to have a due diligence report prior to them even talking to a company about financing. They want to take a real quick initial assessment to see if what they're being told is true. And then it increases in intensity and scrutiny all the way to finalizing the terms of the financing. And this, when they get this far, will be a complete detailed review on all aspects of the property. And the amount of work and the cost of these things can vary tremendously. For example, if you're purchasing a project that's in feasibility stage and you're spending $2 or $3 billion on this project, the financing institute or purchaser may decide that they want to do some independent re-drilling to verify that that 300 meters of 5% copper actually is there. And they will take their own drill rigs, they'll take their own geologists, they'll take their own samples, they'll do their own assaying just to verify it. And so sometimes these due diligence reports can run into several $1,000,000. And a lot of times you'll see these also, besides being referred to as a due diligence report, as an independent engineer's report. As we move down to valuation reports, those are very different depending on purposes also. A valuation report, while frequently containing many aspects of a technical summary report, the main purpose of a valuation report is to assess a specific economic or accounting parameter of the mineralization or mining projects. Valuation reports, as I said, was very different depending on their purpose. You can have a valuation report to determine the fair market value of a project, or what a willing buyer and a willing seller would negotiate on as a price. Valuation reports include analyst reports, which is what stockbrokers will produce on a project or a deposit. And it's really a marketing tool so that they can predict, well, the stock price is too low or too high, or it's, we project that it's going to go here, or it's going to fall, whatever. It's also valuation reports. There's a category called litmus testing. And these are reports usually for accounting purposes to check the validity of a declared mineral resource or reserves. For example, if the gold price drops, $300 or $400 per ounce, do you still have a project? And if not, then they're required by law to write things down or off. Other valuation reports we see and we deal with frequently is damage assessment or value of lost production, such as what was the value of the lost production when Kennecott had the big slide? The insurance company needed to know that. Okay. We also see in the stock markets, you have to have a valuation report to justify the share price on an initial public offering. And there's 101 different types of valuation reports, and they all have a specific purpose in mind, and therefore how they're done and the value that they are determined is specific to their purpose. A lot of times we think that the feasibility report or the pre-feasibility report or a PEA determines the value of a project. And that's only the value of the project to the company that is promoting that project. As we're closing and thinking back to feasibility studies and designs, and especially with the projected public reporting or public disclosure reports, there's a lot of times a lot of adjectives used to describe a report, which tend to be misleading. and you should always avoid these. One of them I see very frequently is that an NI 43-101 or JORC compliant. First thing to note is there's no such thing as an NI 43-101 or JORC compliant reports. Reports can be prepared following CIM or NI 43-101 or JORC guidelines for public reporting, but they cannot be called compliant. As this term has certain legal implications, and both the CIM and JORC will deny that there's any report that is compliant, because that involves that they meet 100% CIM or JORC standards. And they can be prepared to those standards, but neither CIM or JORC can guarantee that they are compliant to their standards. And so, if you see something that says that it's NI 43-101 or JORC compliant, you need to take a double look at that. Other things is you get the adjectives of definitive or final feasibility study. Again, no such thing. It's either a feasibility study or it's not. This term is a misuse of the terminology in order to hype the share price. A feasibility study, by definition, should be definitive or final. If it's not, then it should be titled a pre-feasibility study. Another term that's used that really has no meaning is bankable feasibility study. The term bankable is really subjective to the lending group or the bank that's trying to finance it. All positive feasibility studies should, in theory, be bankable. That's part of the definition as we saw on slide 12. So if it's not bankable, then it may not be a true feasibility study. Or the project may not have adequate economics to attract financing. Or the risk profile of the project may be unacceptable to particular lenders. And an interesting note, in the past, the US SEC unofficially defined a bankable feasibility study as a project study that has been prepared in enough detail so that it is acceptable to an investor or a lender for financing. You can find 10-page studies that an investor or a lender have been known to finance, and they're far from what we would consider even a feasibility study. Mostly back of the envelope, back of a napkin drawings and stuff like that. So as we look at it, just the review, we have feasibility evaluation technical reports, public disclosure reports, due diligence reports, valuation reports, and we'll be looking at some aspects of all four of these categories during the course of the semester. Thank you.